Hi, my name is Wilson Pun. I'm a real estate attorney in New York. And over the past 10 years since I've been practicing, I've helped hundreds of clients both buy and sell commercial and residential property. Today, we're going to be talking about mortgage brokers, the mortgage application process, the types of information and criteria they're looking for when it comes to underwriting, and how an attorney can help you, guide you throughout this entire process. So we've spoken about this a bit before. A mortgage broker will be a third party that will have access to different lenders at their disposal to be able to help you find a lender that'll give you the most competitive terms. So instead of an individual going out to different banks and different lenders, sort of submitting their financial information each time to get a quote for an interest or a loan term that's acceptable to them, one at a time. This mortgage broker will be able to take all of your information once and sort of shoot it out to different lenders that they work with and come back with different loan terms and run it by you and see which ones you like to use the most.
So what would be the difference between a mortgage broker and a mortgage officer that works with a single bank?
Loan officer that works for a specific bank, they'll take all the information that they need to sort of underwrite the loan to begin with. So they'll look at your financials, they'll require your pay stubs, they'll see what other debt payments you may have, they'll see how long you've been in your job for. So a lot of financial background information, and then they'll run it through the loan programs that specific bank or lender offers, and they'll come back and either tell you that you may be a fit for loan A or loan B, or they may not have any loan products for you at all. And for you, if you're doing this process on your own, you would essentially have to go to different loan officers at different lending institutions and resubmit your information and have this conversation multiple times. If you were to use a mortgage broker, it would be the same process. You would submit all your financials and financial information, job history, debt history, and all that information that a lender may need for underwriting. And then that mortgage broker will compile that information into a way that's more easily digestible and processable to provide to these loan officers, and they'll provide them to their contacts, these loan officers, multiple loan officers at once. So you're able to cover a wider area in a shorter period of time. So it's essentially saving you time and effort to try and get you the best available loan possible.
So to save the time and energy for a client to do this on their own, does using a mortgage broker come at additional cost?
A mortgage broker, yes, typically does come at additional cost, and depending on the mortgage broker, you can interview several to see which ones you want to work with. Their fees are usually disclosed upfront, and they're either paid by a lender who the mortgage broker has a relationship with, or they're paid by potentially the borrower. So getting to know what the costs and fees are for different mortgage brokers is very key in deciding who you want to use and making sure that the cost of having a mortgage broker sort of outweighs the benefits of having a mortgage broker outweighs the costs that may be associated with having one.
The most common mortgage types, can you tell us what would be the most mortgage types that you've seen so far?
For residential mortgages, typically we have a smaller mortgage type pool that we typically see. For the most part, you see a lot of fixed rate mortgages, either for a 30-year term, or less common is the 15-year term, which we also see. So what that refers to is the amount of the loan and how long the duration is amortized over that period. So when you have a 30-year mortgage term, the amount that you're borrowing plus interest is amortized into payments that are separated over 30 years. Whereas if you have a 15-year mortgage, it's the same concept, it's fixed rate. So the amount you're borrowing now, along with interest, needs to be repaid in only 15 years. So your payments are probably approximately doubled. But the trade-off there is on a 15-year mortgage, because it's a shorter term, the interest rates are usually a bit better. So if you're in a position to repay a higher principal payment, a 15-year fixed rate mortgage will allow you to get a bit more competitive on the interest side. Aside from fixed rate mortgages, we also have the adjustable rate mortgages. So those products, typically they're always available, but they typically change in popularity, throughout, depending on the interest rate cycle and how people perceive the interest rate changes to take place in the future. So adjustable rate mortgage products, we typically have the 5-1 or 5-6, 7-1 or 7-6. So what those numbers mean, the first number is the period that the interest rate is fixed. So when you have a 5-1, it means that the interest rate is fixed for the first 5-year term, and the 1 would mean 1 year, that it would adjust every year annually based on the prevailing interest rate then, along with a certain margin on top of whatever the vendor decides to charge. So those typically offer a lower teaser interest rate, so to say, during the initial fixed rate period, but then when they adjust, they may adjust upwards. So there's definitely some risk there. And similarly for a 5-6, you have the 5-year fix up front, 6 meaning they will adjust every 6 months and so on.
Why is that? The buyer is obligated to get a mortgage that is no less than the 30 years.
So when a contract says that the buyer can't apply for no less than a 30-year term, what they're typically ensuring in the contract is that any loan term that's less than 30 years, so for example, a 15-year or even 5-year, the shorter your loan term is. So any loan term that is shorter than 30 years, the shorter the loan term, whether it's 15 years or 5 years, the shorter the loan term, the more difficult it is to obtain a loan. So it's another underwriting consideration, similar to how the contract sets forth a threshold, a mortgage contingency. Let's say that's usually, 70% of your loan. You're not allowed to apply for a mortgage that's more than 70% of your loan. So if you get if you're buying a property for $1 million and you're allowed to borrow up to $700,000 on mortgage contingency, if you as the potential purchaser or purchaser on the contract apply for a mortgage of $750,000 and you get rejected, you just violated the terms of your contingency. You can't get your down payment back. Why is that? The more similar to the other question regarding term and the time period of the mortgage, the more money you borrow, the more likely it is that obviously you're going to not be approved for the loan. The less money you borrow, the more likely it is that you'll be approved for a loan. It's all based on the bank's underwriting and what sort of risks that they can tolerate on each sort of mortgage that they are able to approve of.
Okay. So on the seller side, can you just elaborate a little bit more on what does this mean on the seller side, on why they would want to put this in the contract?
Okay, sure. So for a seller, when they enter into a contract, they have the other side of the consideration taking place. You may have finally accepted an offer. You turn down multiple other offers to accept this one. And now this purchaser is looking for financing. They're looking for a mortgage contingency, and you're always worried about what if this purchaser doesn't get their financing approved. If they don't get it approved, now you have to start the process all over again. So as a seller, that's not very appealing to you. So while sometimes you understand the realities that a purchaser may not have all that money up front to just pay the full purchase price that they will need a mortgage, you also want to reduce your exposure to that risk and reduce the chances of, for example, a purchaser applying for a loan that they have no right applying for, getting rejected, and then forcing you to have to restart the whole process again and wasting everyone's time in general. So that's something that you want to avoid. So in order to do that, you speak with your agent, you speak with your attorney to make sure that the contract sets some reasonable parameters in place for what a potential purchaser is able to apply for so that everyone stays on course.